Afternoon, everybody. Welcome to Liberty Call. Today is Friday, December 8th, 2023. Hope everybody's having a good day out there. It's a bit snowy here in Colorado and overcast, but we shall get through it. Looks like the markets are in a better mood, finishing up the week in a positive mood, not just here domestically, but across the globe. So we'll see where the trends continue to go, but we've been kind of trending downwards in the last couple of days. So anyways, if it is your first time watching Liberty Call, if you could do me a favor, if you could give me some thumbs up, like, share, subscribe, follows, and press the notification bell. Let's go ahead and get into today's numbers. All right. Dow Jones was up 0.36%, 130 points, closed at 36,247. S&P 500 up 0.38%, closed at 4602. NASDAQ up 0.45, closed at 14,403. The VIX fell 5.44% today. It's back down to 1235. Canada up 0.26, Brazil up 0.93, and Mexico down 0.15. All right, over in Europe, Germany was up 0.78, the UK up 0.54, France up 1.32%, the Netherlands up 0.71, Spain up 0.76, Italy up 0.94, Switzerland up 0.95, and Portugal up 0.58. Russian exchanges both green, MOEX up 0.21, the RTSI up 0.29. And the Asian markets, the Nikkei in Japan was down 1.77%. Australia up 0.3%. New Zealand up 0.39%. In China, the Shanghai was up 0.11%. The Shenzhen Component up 0.36%. China A50 up 0.34%. DJ Shanghai up 0.08%. Hang Seng down 0.11%. And the Taiwan weighted up 0.61%. All right. So that's everything for today. Let's go ahead and jump over to the weekly markets and see how they performed. Starting out with the Dow Jones, looks like it's going to start or it's going to finish the week out pretty much flat, up 0.08 because we had a pretty sizable drop on Monday and held that most of the week. So S&P 500, let's see, it's going to finish up about 0.79. The NASDAQ up 1.63. The Dow Utilities up about 0.2. And the Dow Transports finished the week in the red, down 1.29%. So, yeah. Again, my personal feeling is that just feels like the markets are just kind of waiting to see what's going to happen long term. We have a Fed meeting coming up. And and just to see how the Christmas season goes. Excuse me. All right, let's go ahead and get into the economic data for the week. Hang on a second. All right. Starting out with jobless claims, they came in at 220,000. Forecast was 222. Last week's number was 219. Continuing claims came in at 1.861 million. The forecast was 1.91 million. And last week's number was 1.925. So down by about 60,000 there. Factory orders month over month contracted by 3.6%. The expectation was a negative 2.8. Last month's number was a positive 2.3. The ISM Purchasing Managers Index came in at 52.7, above the 52 forecast. Last month's number was 51.8, so a little bit of growth there. The Job Openings and Labor Turnover Survey shows that there are 8.733 million jobs out there. The forecast was 9.3, so about 600,000 off. Last month's number was 9.350 million. So it has been trending down since, what was the peak here? That was May of last year. It's been trending down since then. Granted, it did go up quite a bit since the summer of 20. All right. The non-farm employment change grew by 103,000. The forecast was 130. Last month's number was 106. And non-farm payrolls grew by 199,000. Forecast was 180. So, these reports are all over the place. Like one report's way low, one report's high. So last month's number was 150,000. The labor participation rate is currently at 62.8%, forecast 62.7%. Last month's number was a 62.7%. The unemployment rate is dropped to 3.7%. Forecast was 3.9. That's what it was last month. So a little bit of an improvement there. And the consumer sentiment is up to 69.4. It jumped from 61.3 last month. And the forecast for this month was 62. So not quite sure why it jumped so much. It had been on a steady downtrend for most of the year. And just to jump up like that is a little bit odd. All right. Let's get over to the market recap. Stocks hold gains despite jump in Treasury yields on strong jobs report. Yeah, because the thought is that if the jobs report numbers look good, that's going to give the Fed ideas that they want to continue to raise rates, which the people in the market don't want that to happen. They want rates to go back down so that their growth stocks will go back up. All right. U.S. stocks maintained gains on Friday despite a surge in Treasury yields following a stronger than expected jobs report ahead of the Federal Reserve's upcoming rate decision. Non-farm payrolls increased by 199,000 in November, surpassing economists' expectations of 180,000. Average hourly earnings rose at a monthly pace of 0.4%, accelerating from the previous month and exceeding predictions. The unexpected drop in the unemployment rate to 3.7% added to the positive job market data. However, the uptick in wage growth, which has been potential to fuel inflation, led to increased Treasury yields, complicating the outlook for potential rate cuts. Some economists downplayed the strength of the report, attributing it to the return of workers who were on strike. Despite the positive overall market sentiment, there were notable individual stock movements. Broadcom reported quarterly results that surpassed expectations, but refrained from providing guidance for the current quarter, causing uncertainty in the near term. Lululemon Athletica shares rose more than 5% despite weaker fourth quarter revenue guidance, as upbeat commentary from management left room for potential upside. DocuSign's shares reversed earlier losses, rising 6% following its quarterly results and cautious margin guidance. Smith & Wesson brand saw an 8% decline after reporting earnings below expectations, while Bluebird Bio gained as Morgan Stanley upgraded its rating to equal weight. In the energy sector, stocks rose on Friday, but were set to end the week over 3% lower, reflecting concerns about oversupply and weaker demand, leading to a seventh consecutive weekly loss. Oil prices rebounded 2%, but the sector faced challenges earlier in the week due to sharp declines in oil prices. So that's some good news. Oil prices have been receding here in the recent weeks, as much as OPEC has been trying to keep the price up by cutting production and exports. But we seem to be offsetting that here domestically, which I don't know, kind of a good thing. All right, let's get into the jobs data a little more. U.S. economy adds 199,000 jobs in November. The U.S. economy exceeded expectations in November, adding 199,000 jobs, reflecting resilience in the labor market. The Bureau of Labor Statistics reported an increase in non-farm payrolls, with notable gains in healthcare, government, and the manufacturing sector following the resolution of the automotive industry strike. Average hourly earnings rose by 0.4%, outpacing predictions, while the unemployment rate unexpectedly declined to 3.7%. These robust job market indicators complicate the narrative, suggesting that the Federal Reserve's tightening monetary policy might be cooling labor demand. Earlier data had indicated a slowdown in job openings and fewer resignations in October, leading to concerns about a weakening job market. However, analysts at Evercore ISI argued that these signals of a weak employment report were not accurate. The Fed's focus on tightening borrowing costs is aimed at addressing the tightening labor market and easing upward pressure on wages to combat inflation. The solid job report has implications for traders anticipating clues about potential Fed rate cuts in the coming year. The probability of a quarter-point rate reduction as early as March, as per the CME's FedWatch tool, decreased to just under 46% after the jobs update, down from over 55% a day earlier. The U.S. equity markets opened lower in response to the jobs report, while the U.S. 2-year Treasury yield and benchmark 10-year yield both advanced. The reaction underscores the market's sensitivity to interest rate expectations, with the strong jobs report suggesting that the market may have been premature in pricing in rate cuts in the first quarter of the coming year. I wonder who had said something like that. This dude. All right. Last up comes from our friends over at Zero Hedge. This article is titled "The Financial Disaster No One's Talking About," and this was written by Brandon Smith via Alt Market. All right, let's see what he had to say. All right. In the recent article, Brandon Smith predicts that the U.S. is heading toward a debilitating economic condition known as stagflation, marked by rising prices, stagnant wages, and falling production. Smith contends that the U.S. has not experienced such a scenario since the 1970s and suggests it will be a prominent concern for Americans. He points out that despite the economic challenges, the situation in the 70s, characterized by high inflation and overall poverty, was more severe. Smith draws parallels between the current economic conditions and the stagflationary period of the 70s. He highlights the Federal Reserve's approach to monetary policy and its impact on the economy. On the economy, he mentions that the U.S. national debt has reached $33.8 trillion with a 120% debt to GDP ratio, and the rapid accumulation of debt is a cause for concern. He emphasizes the precarious situation of the U.S. economy built on a foundation of intrinsically worthless currency and excessive debt. He points out that the slightest rise in interest rates could have significant repercussions due to the massive debt burden. Smith compares the current debt levels to those of the early 1980s and underscores the potential risks associated with rising interest rates. According to Smith, the U.S. government is borrowing money to make interest payments and fund deficit spending, contributing to a destructive debt spiral. He warns that higher interest rates could lead to a deflationary crisis, causing massive unemployment and economic turmoil. Smith suggests that the ongoing economic challenges, including a crash in manufacturing and industrial sectors, frozen wages, and layoffs, are indicators of an impending recession. In conclusion, Smith anticipates a major shift in the behavior of the economy next year in 2024, with discussions shifting towards the exploding national debt and the Federal Reserve's dilemma between maintaining rates or resorting to stimulus. He emphasizes the urgency of owning financial assets not based on debt, highlighting physical precious metals as tangible safe haven stores of value. Smith encourages readers to take steps to protect their financial independence before it's too late. Yeah, it's a mess out there, and I mean, basically said, what I've said before is that the Fed has really two courses of action: continue to keep rates either where they're at, or continue or increase them if inflation does start to spike again, or at the first little bump in the road, slash rates back to zero like they've done the last few times when there was a roadblock in front of us. And again, it solves the problem temporarily for a short period of time, but it builds up a lot of inflation in the system. And then when it pops, then we have $5 gas, and your bread is, grows up by 30%, and your eggs are $7 a carton. So anyways, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. Hope you have a wonderful weekend, and I'll talk to you next time. Adios.